Welcome back to Wealthwise, the podcast where clarity meets strategy. There is one financial decision that can quietly determine whether you spend your life building wealth or just building someone else's. It's a decision most of us are told to make, but almost none of us are taught how to make. Today, we are pulling back the curtain on one of the most critical relationships in your financial life, your relationship with a financial advisor. We're going to dissect how to choose an advisor who genuinely accelerates your wealth instead of one who slowly erodes it through fees and conflicting interests you might not even know exist. Our guide for this crucial conversation is Max Wise. Max is a renowned financial educator and the founder of the financial media platform Briefs Media. And he's someone who has spent his entire career demystifying the very industry we're talking about today. In this episode, you are going to learn 3 game-changing things. First, the hidden fee structure that could be silently costing you a fortune, potentially hundreds of thousands of dollars over your lifetime. Second, how to spot the 4 different types of financial advisors and instantly know which one is actually aligned with your goals. And third, the single most important question you must ask before handing over a single dollar. A question that will reveal everything you need to know about their integrity. So Max, a huge welcome to Wealthwise. It's fantastic to have you on the show.
Sarah, thanks for having me. It's a pleasure to be here. This is a topic I'm incredibly passionate about.
I can tell, and I want to dive right in. For so many people, the advice they hear is, you need to get a financial advisor. It's presented as this simple, responsible checkbox to tick on the path to becoming a real adult. But you argue that this step is one of the most misunderstood and potentially dangerous forks in the road. Why is that? Why is a topic that seems so straightforward actually riddled with confusion and risk?
That is the perfect way to frame it, Sarah. The core of the misunderstanding comes from a single, flawed assumption that the term financial advisor is a protected, standardized title like doctor or CPA. It's not. The reality is the term financial advisor is more like the word coach. Anyone can call themselves a coach. You can have a brilliant, life-changing coach, or you can have someone who just took a weekend course and has no idea what they're doing. The financial world is startlingly similar. These individuals all operate under different rules, different incentive structures, and most importantly, different ways of getting paid by you. And that difference is everything. Let me put this in real hard numbers that people can feel. Imagine you're 30 years old and you invest your money with advisor A. Now imagine your friend does the exact same thing with the same amount of money in the same market, but with advisor B. 30 years later, you both check your accounts. Your friend has $4.9 million. You have $4.6 million. You lost $300,000, not because your investments were bad, not because the market crashed. You lost it simply because of the fee structure your advisor used. $300,000 isn't a rounding error. That's a paid-off mortgage. That's a college education for your kids. It's real life, and it vanished into fees you probably never even thought to question.
Wow, that is a staggering difference. It's the kind of thing that happens so quietly you'd never notice it year to year, but it compounds into a life-changing amount of money.
Exactly. It's a silent killer of wealth. And it's not just theoretical. I remember a specific case that has always stuck with me. I was speaking with a brilliant young software engineer from Austin. This guy was doing everything right, making a great salary, saving aggressively, maxing out his 401k. He hired an advisor from one of the big household name firms. The advisor was friendly, confident, and talked a great game. A few years went by, and the engineer noticed his portfolio was basically flat. Meanwhile, the S&P 500 had been on a tear. He couldn't understand it. So he finally dug into the statements, and what he found was that he hadn't been put into simple, low-cost index funds. He'd been sold a portfolio of high-commission, actively managed mutual funds that were chronically underperforming. His advisor wasn't working to maximize his returns. His advisor was a salesman working to maximize his own commission. The advice was just a byproduct of the sale. And that right there is the fundamental conflict of interest we need to expose.
That's terrifying. So it's not just about finding someone who is smart or someone you get along with. It's about understanding their entire business model from the ground up. It sounds like most of us are walking into a minefield without a map.
That's exactly it. But the good news is there is a map, and it's much simpler than the industry wants you to believe. It really boils down to decoding those 4 types of advisors I mentioned and knowing that one critical question to ask. Once you have that map, you hold all the power. And I think that's exactly what we're about to break down.
All right, Max, you've laid out this incredible, almost dangerous landscape where a simple choice can have a $300,000 impact. So let's get that map you were talking about. Let's decode this for our listeners. You mentioned there are different types of advisors. Specifically, how are they actually making money from us? Break down these different models.
Absolutely. This is the most important foundation to build. Think of it like walking into an ice cream shop. There are lots of different flavors, and they all look good, but what they're made of is fundamentally different. In the advisor world, there are essentially 4 main flavors, and they're defined by how they get paid. First, you have the fee-only advisor. This is the cleanest, most transparent model. It's exactly what it sounds like. The only compensation they receive is the fee you pay them directly. This can be a flat annual fee, say $5,000 a year for a comprehensive plan. It could be an hourly rate, maybe $300 an hour, just like you'd pay an attorney. Or the most common way is a small percentage of the assets they manage for you, often called AUM, assets under management. For example, they might charge 1% of your portfolio value each year. The key here is that their incentive is directly aligned with yours. If your portfolio grows from $500,000 to $600,000, their fee increases proportionally. They are on your side of the table, because when you win, they win. There are no hidden kickbacks or secret handshakes.
Okay, that makes perfect sense. Straightforward. What's the second flavor?
The second flavor is the one that gets a lot of people into trouble: the commission-only advisor. These individuals are less like a financial strategist and more like a financial product salesperson. They don't charge you a direct fee. Instead, they make their money from commissions paid to them by the insurance or investment companies whose products they sell you. So when they recommend a specific mutual fund or a particular life insurance policy, you have to ask, are they recommending it because it's the absolute best option for me, or because it pays them the highest commission? The conflict of interest is baked directly into the model. Imagine a doctor who gets a huge kickback from a pharmaceutical company for prescribing their specific brand of medicine. You'd be skeptical, right? It's the same principle.
That's a powerful analogy. And it feels like that conflict would be very hard to see from the outside if you don't know to look for it.
It's almost impossible to see, which is the danger. Now, the third flavor is perhaps the most confusing of all, and its name is almost designed to be confusing: fee-based. It sounds a lot like fee-only, but it is a world apart. A fee-based advisor is a hybrid. They do charge you a fee for their advice, maybe a percentage of your assets, just like a fee-only advisor. But they can also earn commissions by selling you financial products. They get to double dip. This is where it gets incredibly murky. One minute they might be giving you objective advice, and the next they might be selling you a high commission annuity. It creates a massive gray area where you, the client, never truly know which hat they're wearing, the advisor hat or the salesperson hat.
So they can switch roles without you even realizing it? That feels even more complicated than the commission-only model.
It is, because it's cloaked in a veil of legitimacy. Finally, the fourth flavor is perhaps the performance-based advisor. This is more common in the world of hedge funds and high net worth individuals.
Here, the advisor takes a percentage of the profits they generate for you. A classic model is 2 and 20, where they charge a 2% management fee and take 20% of all the profits. Their incentive is purely to make you money, which sounds great. The catch is this structure is typically only available to accredited investors with millions to invest because the advisor's taking on significant risk and it's not worthwhile for them on smaller accounts. So you have fee-only, commission-only, fee-based, and performance-based. 4 completely different business models, all hiding under the same generic title of financial advisor.
That's an incredibly clear breakdown. It feels like the first step isn't to look at their track record, but to look at their paycheck.
You've hit on the most important point.
So what I'm hearing is, before you ask an advisor, how much money can you make me? The first and critical question should always be, how do you make money from me?
Okay, Max, that breakdown of the 4 models is a game changer. But beyond understanding the fee structures, is there a single litmus test, a North Star we can use to filter through the noise and know with confidence that someone is legally and ethically bound to act in our best interest?
Yes, there's one word. And every single person listening needs to write this down and burn it into their memory. That word is fiduciary. A fiduciary is an individual or organization that has a legal and ethical obligation to act in the best interest of another party. In this context, it means the advisor must, by law, put your financial interests ahead of their own. It's not a suggestion, it's a legal duty. This might sound like something every advisor should be doing anyway, right? It seems like basic common sense. But shockingly, it is not the universal standard.
Wait, you're saying that not all financial advisors are legally required to put their clients' interests first? That's mind-blowing.
It's the industry's dirty little secret. Advisors who work on commission, for example, are typically held to a lower standard called the suitability standard. This just means the product they sell you has to be suitable for your needs, but it doesn't have to be the best or the lowest cost option. An expensive, high-commission mutual fund might be suitable, but a simple low-cost index fund would have been in your best interest. A fiduciary would be legally obligated to recommend the latter. This is why connecting the dots back to our 4 models is so important. Fee-only advisors are almost always fiduciaries. Their entire model is built on that trust. Commission-only advisors are generally not fiduciaries. And the fee-based advisors, they are the chameleons. They can be a fiduciary one moment when giving you a financial plan, and then switch to a non-fiduciary salesperson the next moment when selling you an insurance product.
So how do you pin them down? How do you make sure you're getting that fiduciary commitment?
You ask them directly, and you ask for it in writing. The question is simple. Are you a fiduciary, and will you sign a statement confirming that you will act as a fiduciary for me at all times in our relationship? If they hesitate, if they give you a long-winded explanation about different standards, if they say, well, most of the time, that's a giant red flag. A true fiduciary will say, yes, absolutely. It's a simple yes or no question. Hiring a non-fiduciary advisor is like asking a fox to babysit your chickens. He might seem friendly, but you can't be surprised when you come home to a bunch of feathers. Always, always demand that legal commitment in writing.
This is all incredibly clarifying, Max. But it also sounds like finding a genuinely good, trustworthy advisor is like navigating a minefield. Which brings me to a bigger question. Does everyone actually need a financial advisor? Especially those of us who are just starting out and maybe don't have a massive portfolio to manage yet.
That's the million-dollar question, and I'm going to give you an answer that might surprise some people in my industry. No, absolutely not. The idea that you need a professional to manage your money from day one is one of the biggest myths in finance. For the vast majority of people, especially in the first 10 to 15 years of their wealth-building journey, there are 2 powerful, effective paths you can take entirely on your own. The first, and the one I recommend for about 90% of people, is passive investing. This is the superhighway to wealth that is available to everyone. It's the simple, proven strategy of consistently buying low-cost index funds or ETFs that track the entire market, like the S&P 500. You set up an automatic investment every week or every month, a strategy called dollar-cost averaging, and you just let it run. You don't try to time the market. You don't try to pick the next hot stock. You simply buy the whole haystack instead of looking for the needle. History has shown this strategy outperforms most professional money managers over the long run. You don't need an advisor to do this. You just need a brokerage account and the discipline to stay the course.
The set it and forget it approach. What's the second path for those who might want to be a bit more hands-on?
The second path is active investing. This is for the person who genuinely enjoys research, who wants to analyze companies, and who has the stomach for more risk. This is the path of trying to find those individual stocks, the next Amazon or Nvidia. It requires significantly more work, more time, and more emotional resilience because you will be wrong and you will lose money on some of your picks. It carries the potential for higher returns, but also the certainty of higher risk and effort. It's not for everyone, but for some, it's a deeply rewarding hobby or even a passion. What I personally do, and what many people find works best, is a hybrid of the two. The bulk of my net worth is on autopilot, passively invested in low-cost funds. That's my foundation. Then, I have a smaller, separate account that I use for my active investments. That's my play money, so to speak. This way, my core financial future is secure, regardless of whether my active picks pan out.
So if we can do this ourselves, when does an advisor actually become essential?
A great advisor, a true fee-only fiduciary, becomes invaluable when your financial life gets complex. They are not just stock pickers. Their real value shines when you're dealing with things like advanced tax planning, navigating complex employee stock options, selling a business, setting up trusts for your children, or planning your estate. They are the specialists you bring in when your financial situation is no longer a simple save and invest equation. They become your personal CFO, helping you navigate the big, complicated crossroads of life.
I love that. So the message is, you don't need a 5-star chef to make a great sandwich for lunch every day. In the same way, you don't always need an advisor to start the simple, powerful act of building wealth. Max, listening to you break all of this down, I can hear the passion in your voice. It's not just academic for you. This feels deeply personal. I have to ask, was there a specific moment in your own financial journey, a failure or a breakthrough, that set you on this path and made you so committed to bringing this level of transparency to the industry?
Yeah, you're right, Sarah. It is deeply personal. It comes from a place of being on the other side of the table, being the person who didn't know what questions to ask. When I was just out of college, I got my first real job. I was making more money than I ever had in my life, and I felt this immense pressure to be smart with it. I thought I was finally playing in the big leagues. So I did what I thought you were supposed to do. I found a financial advisor. He was with a huge, reputable firm, one of those names you see on skyscrapers. He had the corner office, the firm handshake, the expensive suit. He radiated success. I was intimidated, but also incredibly impressed. We sat down at this big mahogany desk, and I felt like I was doing the most adult thing I'd ever done. We talked about my goals, my risk tolerance, all the standard things. I was so focused on the what stocks to buy, what funds to get into, that I never once taught to ask about the how he was getting paid, what his incentives were. I just trusted the process. I trusted the brand name on the door.
Which is what most of us are conditioned to do.
Exactly. So for the next couple years, I diligently sent him a portion of my paycheck. I would get these thick, glossy statements in the mail that I barely understood, but I saw the account value was going up a little, so I figured everything was fine. The turning point came at a friend's barbecue. A couple of my friends were talking about their 401ks and brokerage accounts, and they were mentioning returns like 15% or 20% that year because the market had been on a really good run. I remember feeling this quiet, sinking feeling in my stomach. I went home that night, and for the first time, I didn't just glance at my statement, I decided to dissect it. I printed out 2 years' worth of statements and laid them all out on my floor. I got a highlighter and a calculator. And Sarah, it was a slow, dawning horror.
I realized that while the market was soaring, my portfolio was barely treading water. And when I finally found the fee disclosures buried in the fine print, I felt sick. There were front-end loads, high expense ratios, and something called a 12B1 fee, which I later learned was basically a marketing fee I was paying so that fund could advertise itself to other people. I was paying fees on top of fees. My advisor hadn't built me a portfolio designed for my growth. He'd sold me a collection of products that generated the highest commissions for him.
So you were paying for the privilege of being sold to.
I was his exit liquidity. In that moment, sitting on my floor, surrounded by those papers, the anger wasn't just at him, it was at myself, for being so naive, for being too intimidated to ask the simple questions. I realized I hadn't lost money to the market, I had lost it to my own partner. I lost my hard-earned capital, and more importantly, I lost 2 years of compound growth I can never get back. That failure became my fuel. It transformed into a mission. I promised myself I would spend my career demystifying this industry, giving people the map that I never had so no one else would have to feel that same sickening feeling of betrayal. That's why I'm here.
Max, thank you for sharing that. That story brings this entire conversation from the theoretical to the profoundly real. It makes the stakes crystal clear. So, looking forward from that experience, if you had to bet on one major shift in the next 3 to 5 years that will redefine how we interact with financial advice and hopefully avoid stories like yours, what would it be?
I'd bet everything on a model I call the hybrid human. It's the convergence of artificial intelligence and genuine human connection. And I believe it will fundamentally split the role of a financial advisor into 2 distinct parts. Right now, we often hire one person to do everything: the math, the stock picking, the planning, and the hand-holding. That's inefficient. The future, I believe, looks like this. First, you have the AI/machine component. This is the new tactical engine. AI and sophisticated robo-advisors will handle all the things that computers do better than humans. We're talking about data analysis, portfolio construction, automatic rebalancing, and especially tax loss harvesting, all done with ruthless, unemotional efficiency at a fraction of the current cost. The machine will manage the spreadsheet. It will build you the mathematically optimal low-cost portfolio in seconds.
So the tactical number crunching part becomes automated and commoditized. Where does that leave the human advisor?
It frees them up to do the one thing the machine can never do. The human advisor's role shifts from being a portfolio manager to being a behavioral coach and a financial therapist. Their value will no longer be in picking stocks, but in managing you. Their job will be to help you navigate the complex, messy, emotional landscape of money. They're the person who talks you off the ledge when the market crashes and your primal lizard brain is screaming, "Sell!" They're the person who helps you and your spouse merge your finances without it ending in divorce. They're the ones who help you create a plan for a special needs child or navigate the emotional weight of a sudden inheritance. The machine manages the spreadsheet. The human helps you manage your soul. Their primary role will be to understand your values, your fears, and your deepest life goals, and then use the powerful tools of the machine to build a bridge to that future. The best advisors of tomorrow won't be the best stock pickers. They will be the best listeners, and they will, of course, be fiduciaries.
So the future of advice is technology for the tactics and a human for the trust and the tough conversations.
Exactly. And that's a future that's much better and much safer for investors.
Max, this has been an absolute masterclass in clarity. You've taken a topic that feels intentionally confusing and made it not just understandable, but actionable. Thank you so much for your time and for sharing your story with us today. To everyone listening, let's quickly recap the powerful framework Max gave us. 1. Understand the 4 models. Know whether your advisor is fee-only, commission-only, fee-based, or performance-based, because how they get paid determines the advice you get. 2. Ask the golden question. Are you a fiduciary, and will you state that in writing? A no or a maybe is a clear signal to walk away. And 3. Recognize that you have the power to start yourself. Passive investing is a proven, effective path to wealth that doesn't require an advisor from day one. If you found value in today's episode and it sparked a new way of thinking for you, we ask you to do 3 simple things. First, share this episode with one person in your life, a friend, a sibling, a coworker, who you know is thinking about their financial future. You could save them from making a very costly mistake. Second, if you haven't already, hit that subscribe or follow button for WealthWise. We bring you these kinds of breakthroughs every single week to help you build a life of financial agency. And finally, leave us a comment or a review. Let us know what your single biggest takeaway was from this conversation. We read every single one. Max, thank you again.
It was my absolute pleasure, Sarah.
And for all of our listeners, remember this. A great financial advisor can be a powerful partner, but they are not a magician. The real magic isn't a secret formula they hold. It's in the knowledge that you now hold in your hands. Financial freedom isn't a dream you just hope for. It's a strategy you execute.